supply argument for precious metals is just as strong as the demand side, which is driven by the imbalances. So it's a real supply and demand mismatch, in my opinion, and the miners are going to play a big role into this.
Hello, everyone, and welcome to another episode of Inside the Markets presented by StockPulse.com. We are more than honored to be sitting down today with Tavi Costa of Crescat Capital. Thank you so much, Tavi, for joining us today.
Thanks for having me, Justin.
So, we've had a big year in the markets. I'm curious, what have you been keeping an eye on when it comes to the precious metals sector?
I think has been a lot of things. I think the inflation problem that was something perhaps we thought it could be possible, but certainly it's something that has been building up for some time now. I think the average investor doesn't fully grasp the idea that inflation is something that develops a lot further, at least throughout history. A lot of market participants have not been really seen this issue. Only people that really lived through the 70s or lived in other economies that have had inflationary issues. And so I think this is going to be creating a setup for precious metals that will be starting to benefit from this macro environment. We think inflation has really three pillars. We think there's a wealth transfer from the government to the people. We think there is a wages and salaries, a secular shift where we're going to see a huge growth of remuneration of households in general in the U.S. In developed economies. And the third one is the suppression of rates. Ultimately, the Federal Reserve is going to be responsible for continue to suppress rates in order to allow the government to issue more and more debt. There's a lot of technicality inside of that, but the overall picture seems very inflationary going forward. And so what a time to be allocating capital into a space that is still historically undervalued, and that still has a lot of embedded growth into it. So we're really excited about the space, and that's this macro setup will be the tailwind, in our opinion, to much higher gold and silver prices.
Are there any parallels between the 1970s and today that you are looking at as it relates to either the economy or precious metals?
I think there's a lot. I think number one, I would start with the supply issues that we're seeing today are somewhat similar as far as capital investment in this natural resource space. That's one of them. I think that the inflation gene is out of the bottle, in a very I guess we saw that in late 60s, and it was somewhat cyclical, but again the three waves of inflation that we saw in the 70s and late 60s, again they built on themselves until the very end of the 70s. um, the very big difference, in my opinion, is certainly the amount of leverage in the system right now is dwarfs what we saw back in those in that period, and the valuation of risky assets, which both of those imbalances are things that force the Federal Reserve to continue to have suppressed interest rates overall. And so we saw the cyclicality of inflation following along with the monetary policy, and monetary policy was trying to match what inflation was at that time. And so if you see a chart of inflation and a chart of short-term rates, they actually follow themselves pretty closely throughout that whole decade. Um, Another thing that is interesting about back then that I think a lot of people ignore is, sure, gold does follow real rates a lot closer. But if you look at the relationship of gold relative to nominal rates in the 70s, was they were always moving in locksteps. Basically, they had a very strong relationship. Correlation was very positive with the two, where 10-year yields were rising and gold was rising along with. And I think there's the average investor today thinks that the possibility of 10-year yields rising could potentially be a problem for precious metals. I'm not sure I am in line with that thought. But those are the big differences. Obviously, the wages and salary spiral that we saw starting also in the mid 60s and going all the way to the 70s was a huge part of what moved the inflationary problem to develop. And I think we're going to see another one today. We saw this secular decline since the 80s all the way to now. I don't think that that's going to be the case here. I think as cost of living begins to rise, we should be seeing the cost of at least wages and salaries, the pressure from households, and may even see protests on the streets. I think we're starting to see some of those labor union protests. Um, and sure, back in the 70s, I think we had the majority of the households were part of labor unions. That is one difference that we don't have today. So there are some differences, but in almost every macro setup and historical perspective will have their uniquenesses. But I think this is in a way very similar. Um, and what really surprises me, if I could just close my thought, is how policymakers are behaving along with the problem. Back in the 70s, if you read the reports of those times, I would say there was a general knowledge and experience by policymakers of dealing with the inflationary problem. I'm not sure that's the case today at all. You don't fight inflation with 0% interest rates and then doing another $400 billion of QE and having a tween deficit, which is at double digits relative to GDP today, and on top of it, restricting most of the natural resource industries to develop, explore, and produce. I don't think that that's the way you fight inflation. And so that general knowledge from policymakers is going to have to be adjusted. And that's going to be a big change in the markets, in my opinion. So, long answer, but that's the way I view this.
Are you buying the talk of tapering from the Fed?
I think the Fed's going to have to taper, but I think it's going to create some implications that will be interesting if you are a macro investor or any investor, and I think you should be aware of it. To answer your question, I do think they're going to proceed with tapering. Um, and what it's going to do to the markets, in my opinion, is it's going to cause 10-year yields to rise. The reason for that is because we're seeing a transition from the government of from short-term maturity debt to long-term maturity debt. So, meaning the average outstanding months of maturity is going to increase significantly in the amount of the outstanding debt of the government in the U.S. So we've seen this in the global financial crisis when they issue a ton of T-bills and then allow those to mature and then started to issue or flood the market with bonds and notes. We saw this again in the COVID crisis where T bills funded basically 90% of the fiscal stimulus coming out of the recession. And now we're seeing the largest amounts, I believe, just in the last 3 months, about $560 billion of T bills mature. At the same time, we're seeing somewhere close to $620 billion of bonds and notes being issued just in the last 3 months. So going back to your question of tapering, who is buying all those treasuries? Well, 35% of what was issued in the last 3 months was bought by the Federal Reserve. They're buying $80 billion of of bonds and notes or treasuries in per month. And so, if you do the math, it's about 35% is what they bought. And so, the question really is who's going to be stepping up. Back in the 40s, you asked a question about giving some historical perspective. Back in the 40s, we had a similar problem where the amount of leverage in the system forced the Federal Reserve to continue to keep the market or the I would say the economic environment very suppressed as far as financial repression. Um, I would say that the big difference is that we did had a war back then, and we issued a ton of bonds, and they called the war bonds, as you know. and households participated on that, and they basically fund a lot of that issuance of treasuries. I'm not sure what would they call it today, inflation bond, and how they would make households, U.S. households, to purchase those treasuries. So I'm very concerned about where the 10-year yields are, because I think they're going to go significantly higher from here. I would say significantly higher is obviously it will depend on discretion of each investor. I think it will see 10-year yields rise to 2.5% and 3%. That's obviously not significant if you look at throughout history, but that will have an impact on risky assets that are observed valuations today, such as software stocks and some other parts of the market. So um, I am, well, you throw on top of that the fact that perhaps inflation is not transitory, which I feel strongly it's not, and it's probably one of the biggest threats um, for Americans in general. And I think not a lot of people are seeing it that way just yet. So I think 10-year yields are very mispriced. That's my 2 cents. And I think the Fed is going to go ahead with taper in 8 months to 12 months from now. If 10-year yields are at 2.5% and 3%, they're going to have to call it a yield curve control. Is that going to work? And that's another question. But I think that's the sort of the newspaper of the future, what we're going to see in 8 to 12 months.
So we've spoken about the 70s, we've spoken about the 40s. When do we start talking about things are looking kind of like 30s?
Hmm. Well, the 30s, I think that we tend to focus. So it's interesting that the inflationary crowd likes to look at the 70s. The the deflationistas like to look at the 40s because they think it's transitory what we're seeing. And back then, it certainly was. Inflation did go above 5% and stayed at those levels for 2 years. Um, but it ended up being transitory, whatever you refer to as transitory. But and it did go to double digits as well. The two similarities with those times were the real rates were very negative. But what we didn't see in those 2 decades, and we did see in the 30s, was the valuation of assets getting to real extreme levels. If you look at equity markets today, and I think a lot of people have been ignoring this, we created arguably the largest speculative bubble in risky assets we've seen in history. um, the only time you can perhaps compare with this would be maybe the tech bubble and maybe right before the Great Depression back in the peak of 1929. Um, but even today, I think it's a lot broader what we're seeing as far as the problem. And when you start thinking about those imbalances and you think about what would ever prevent a central bank from pumping in liquidity to the market, I think the only answer for that is a inflationary problem. And what do we have today? I don't think people are really connecting those dots yet. Um, and so for me as an investor is to be prudent, invest wisely, because I think that those dots are going to matter very soon. As far as the 30s go, there were a lot of differences back then as far as the macro environment, but the valuations of those of assets in general was certainly very excessive. I think today is arguably a lot worse because it's not just equity markets. You're talking real estate, you're talking junk bonds, which didn't even exist at that time. Um, Leverage loans. You have some parts of the venture capital market, the private equity valuations of companies in general. So it's a much broader problem than it was back then. The financialization of compared to what it was back in the 30s is very different. So we unlocked a lot of value out of assets and have created some issues now because everything depends on one factor, and that factor is low interest rates. um, and that environment works until you have inflation. And I think now, we know the Federal Reserve is trapped ultimately, but how trapped it really is, and what does that mean? Um, you know, what it means is that you have this dependency on the government side of continue to issue more and more debt through issuances of treasuries to fund fiscal stimulus. You have very, very strong agenda on the fiscal side from starting from the peak inequality issue, which I think it's pretty clear what we're seeing as far as either trying to bring down the richer parts of the society or trying to impose policies that bring up the bottom 50% to do better. So you have social security improvements as far as payouts. So you have food stamps improving. You have the idea of canceling debt as on the student debt side, and those are all forms of wealth transfer from the government to the people. And then the second agenda that I think it's important has to do with the infrastructure development. That's a huge one. Then you have the green revolution. Then you have this fiscal arms race with China and the U.S. So all those are very important fronts of the fiscal side that needs to be funded over time, which requires monetary stimulus. I don't think we saw that in the 30s at all. And on top of it, I think that the major difference with the 30s that was that gold was pegged, the dollar was pegged um, um, to gold prices, and so we don't have that anchor on fiat currencies today globally, and so those are all major differences that allow not only the lack of discipline um, to to really build in the system, but also it allows policymakers to make things that they probably wouldn't make in the 30s. And so um, I think we are setting up a perfect um, situation here for folks that are invested in commodities and that are hedging that position with different forms of short positions in equity markets. So the commodities to equity ratio, in my opinion, is probably the most relevant chart or relevant idea to be long that I've ever seen. And so, at least for this macro setup, and so I'm very focused on how can I optimize positioning in a portfolio that really reflects that as an idea.
Now, in the period, let's focus in on silver from 1975 to 1979, 80, 81. It took until the end of that period for silver to really start catching a bid, I suppose. How do you see things playing out this time around? And then also, I'm curious, could you kind of speak to the way that it played out in the 70s on the precious metals front?
Yeah, I think the interesting thing about silver that perhaps wasn't the case in the 70s is certainly um, it was much more of a monetary metal than industrial back then, and I think what we have today is this. No, I try to express that by using different forms, but it is an inflationary asset at the end of the day. It's also a monetary metal, and it has a lot of other properties from you know especially this idea of fitting into a green revolution, and the investments that are going to be needed in this new I guess this new era of electrification globally is gonna also need a lot of silver, and so silver kind of fits into the two. It is a monetary metal, and it should be magnifying the returns of gold if gold performs well. Um, the other thing that I think doesn't compare to back then is the geological challenges that we have to find silver and find metals in general, which is something that will progressively get worse until technology catches up to it and perhaps allows us to explore and develop mines much quicker. you still have the issue of getting permits regardless. And so we like all the commodities, but what silver really attracts us is on the supply side, and the supply side of silver is very constrained. Um, and it's already difficult to find silver, and usually when you find silver, it's in locations that are not very easy to operate. From Mexico to Peru and some other areas are like Argentina, which are areas that have historically had a lot of issues with their governments locally to allow those businesses to produce. And so those are the kind of mix of concerns about silver, which are not real concerns. They're actually very positive for the metal. And if you're able to find deposits and projects that are in safe jurisdictions that are actually capable of getting that metal out of the ground in a very viable, economically speaking way, uh, wow, that's probably one of the best investment ideas you can possibly find today as far as asymmetry goes. And so I think, I've been saying this for some time. I think silver is the cheapest metal on earth. I don't know when it's going to start really moving explosively, but I think it will because it's a very thin market. And there's a real lack of, going back to your question, the difference between the 70s and now, also an allocation of capital uh, in regards to uh, pension funds and what we saw today, there is certainly a lack of capital allocation in silver and precious metals. Everyone is really invested in technology, and the other leg of that trade has been fixed income. And so, where will commodities play into this new portfolio thesis? I think silver and gold will play a role in this. Some people think Bitcoin will play a role into this, and sure, it will probably, but I think there is a lot of room for all commodities to capture that liquidity. And I think silver, being one of the big benefiters of this environment, especially being an inflationary asset that is historically undervalued. So I expect silver to be trading at way higher numbers, perhaps even triple digits at some point. I think, hopefully we'll look back and say that's crazy that we were buying silver in that environment at sub, $25 an ounce and sub $30 an ounce, whatever that is. Um, so I'm very bullish on the space in general.
What's your thesis on the miners presently?
Well, the miners is I think you can break it down, especially by looking at the cyclicality of the fundamentals of the industry. Um, Look, the miners have never been so profitable in history, at least that we can get data from. We're looking at free cash flow multiples of 3 to 5 times annual free cash flow as far as enterprise value of those businesses, and those are multiples of companies that are going out of business. I'm not sure if that's the case at all with gold and silver miners. So I disagree with how the market is pricing this in, and I think it's an inefficiency. And we've seen this before. I think that it's important to go back to the 2011 and other times when we had those similar inefficiencies, as far as to the other side of it, where we were at the peak, and you can clearly see that the leverage uh, setup at the time was completely different. I mean, companies were leveraging up at that time like we've never seen before. Today, they're paying down their debt and in cleaning up their balance sheets to levels we haven't seen before. The net equity issuance has been basically dismal in this last decades or so. M&A cycle hasn't even started yet. Maybe we've seen some companies are starting to move and trying to buy some, but they're still very gun shy. We talked to a lot of the majors and the mid tier companies, and there isn't still that interest of getting involved with exploring companies and other more risky projects that are more earlier projects should be the way to say it. Um, as far as the production goes, they're going to have to replenish the production line of the major companies are going to need to go after new projects. And so that has been our focus is to buy high quality exploration companies in different parts of the world that can perhaps benefit from um, this new capital liquidity that will come in from this improvement of fundamentals that those companies are um, going through today. As far as other parts of the mining industry, I think this extreme, I guess, conservative behavior across the management teams of those companies will pay dividends for gold and silver prices in the future, given the fact that we're not seeing the exploration budgets increase and we're not seeing the development of mines to the levels that we've seen before. And so the capex cycle hasn't even started for the miners, and that will be something, in my opinion, that will, like I said before, I think the supply argument for precious metals is just as strong as the demand side, which is driven by the imbalances. So it's a real supply and demand mismatch, in my opinion, and the miners are going to play a big role into this. And I think they're going to be as we move towards a higher cost of capital environment where there is going to be a prioritization towards profitability, and I think the miners are going to be the companies that will probably lead the way as far as being this new growth industry in the next 10 years or so. And so I'm yes, I'm early, but I think we're seeing the lags of this already, and I think we're going to be much. This is just the beginning, really. I think this is a real macro regime change. Then the macro setup will really benefit the miners from precious metals to base metals and others. And so we're really, really excited about this.
We've had the honor of sitting down today with Tavi Costa of Crescat Capital. Thank you so much, Tavi, for joining us today.
Thank you. My pleasure.
And thank you, everyone, for listening.